think the surge that takes that out will be very dramatic and very quick, to where if you're not already in this beast, that'll occur so fast you probably won't participate. It's happened before, and I'm not arguing that when that occurs, that's the end of it at all. I think silver could go, it wouldn't shock me to $100 to $200 ultimately. My personal investments are heavily in silver. Okay. Now we watch gold because it's the mama monetary metal. But silver, people have forgotten, is a monetary metal. It's been for thousands of years. In fact, in the US, it was a monetary metal. I think this time up in the monetary metals is going to be different than the bull markets that we've seen before. Gold went from 30 bucks to 200 back in 1975. Gold went from 103 in 1976 to 850 by 1980. Or it went from 260 in 2000 to 2011. It got up to 1920. But then it had big bear markets at 50% drops. Okay. Don't expect that this time. I think we're going to probably end up with a sort of crisis globally, not just US, that causes a rethinking of what money is and realizing that fiat money creates distortions. And therefore, let's go back to something that is objectively stable. Meaning, when gold goes up to wherever it's going, which may be 10,000 or 20,000, I have no idea. It depends on a lot of these other factors in the crisis mode that they put the world in. It's likely to be institutionalized up there. Same with silver. Now, as far as what I think is going to happen right now with silver, we argued a few months ago after we made that spike low in April, which tried to copy the stock market falsely. Got to 27.50 after having been 35 bucks in a matter of about a few weeks. Much of that occurring in 2.5 trading days. We had that was a cleansing drop that anybody who was week long got out. Within hours, almost, you were back above 30, 32, 33. Now you had dual highs at 35, October of last year and March of this year, where you dual peaked at 35. We argued that's going to be a triple top breakout in price. But getting back up to the high 34 level told us, one, not only are you going to blow out that high, but we're going to launch an acceleration phase in silver that is likely to see silver trounce gold on a percentage basis. And I think silver likely within the next 2 quarters, or certainly by the end of the year, will see itself in the $60, $70 range. Meaning you're going to double the price of silver from where it is now. The old dual highs in silver that existed in 1980 and 2011, either side of 50 bucks, those are phantom. I think they'll come out so easily. And that's when the vast public will say, gee, what's going on here? Well, you should have been in already. But I think the surge that takes that out will be very dramatic and very quick, to where if you're not already in this beast, that'll occur so fast you probably won't participate. It's happened before. And I'm not arguing that when that occurs, that's the end of it at all. I think silver could go, it wouldn't shock me to $100 to $200 ultimately. But I'm focused right now on within the next 2 quarters. Similarly, I think the stock market will expose itself the other way in the next 2 quarters. Probably beginning, obviously, next quarter, for example, which is days away. So that's where my focus is. I think the Bloomberg will tailcoat that to some extent. And I think gold will do quite well. I think gold could easily double, if not more, between now and the end of the year. It'll get up to 8,000. Why do I say that? It's an idiot thing. If you go back and look at the history of gold over the last 50 years, there have been a couple 8-fold moves on a logarithmic scale. If we have an 8-fold, we're going to 8,000. For example, if you look at a silver gold ratio, we do it a different way than most people. We divide an ounce of silver into an ounce of gold. And if you go back 50 years and plot the highest level that ratio was, where you divide an ounce of silver into an ounce of gold, 21 of those 50 years, it was at 2%. That was almost a norm. You didn't even have to have a bull market for silver to be 2% the price of gold. In bull trends, like 1980 or 2011, In the latter phase of those, it got up to 3, 4%. One time even 6. Okay, forget that. Just getting to 2%. Right now, we're just above 1%. Okay. I think that the move to a norm of 2%. So if gold goes to, let's say, 8,000, what's 2% of that? And I'm not arguing you got to do, but right now in the next 5 to 6 months, I think silver could easily get to 60. And at that point in time, easily be 2%, if not higher.
Higher.
And I think the move to get there won't be slow. And that's the important thing. Yeah, no, and the miners, I think the miners will do quite well too over the next year or so in relation to gold. I think they could triple in relative value to gold. Whatever gold does in the next year or so, the miners could do triple that on a percent basis. So my emphasis would be, yeah, we think commodities are going to turn up, but they'll nowhere match gold. Yes, gold's going to continue, but this time the laggards, the wild dog on the leash, silver, is going to suddenly outpace gold. And I think the miners are technically, and we measure this technically, we don't just make a judgment call based on feelings. We actually plot the spread relationship, and technically the miners are breaking out versus gold on a relative basis, meaning they're starting to surge. Well, it's become a little more bleeding obvious in the last several months, where GDX, for example, you'll see a day where gold's down 10, 20 bucks, GDX is up. That's highly unusual, surprises most people. But I think that's about what you're going to see. So if I were to say, where do I put my money for the next 6 months? As bearish as I am on the stock market, I'm not going to short the stock market. I think it's going to be relatively small compared to the percent upside gains you see out of the gold miners and silver. I think it'll, to some extent, help them because of the asset class flow. Another market to watch, which we haven't talked about yet, is the dollar index. Dollar index is a disaster waiting to happen. Back in March, the dollar index was 104.21 on the close. We turned major long-term bearish at that point. And you look at a price chart that was in the middle of the prior 2-year range, didn't mean anything. Now we're trading at 97 today. It's dropped 7% since the March close. If you close any month out during this year below 98.35 by a credible amount, we're below it credibly right now with a couple days left in the month, you're engaging a even longer term momentum structure, a 10-year average momentum oscillator. You're blowing a multi-decade uptrend on momentum. You can't see it on the price chart, but on annual momentum using a 10-year average as your metric, you're blowing the bridge over the River Kwai. It's gone. And I think the dollar could easily implode relative to the other pieces of fiat that it's competing with in the dollar index. It's hard to rank that as important. If we're talking about the euro and the yen primarily, they constitute 70% of the dollar index, the other side of it. But I think the dollar could drop from the 90s into the 70s. That will cause major wave effects in other markets. And factor in this, if the major Forex market's been dormant between 2023 and 2024, it was in the 7% range, doing nothing. So it wasn't creating waves, impacts. It's the quiet one, we called it. It's no longer quiet. And if you suddenly create fractures and volatility in the major Forex markets, that will have wave impacts on other assets.
I was going to say, if the dollar drops in the 70s, that's going to be seismic.
Well, it will, yes. And the real issue is the ongoing decay in the dollar anyway. In fact, if you look at XLE, for example, the broad oil sector ETF, it doesn't really correlate well to the S&P. I mean, there have been plenty of years in the last 10 where the S&P has gone up and the XLE has gone down. Okay, so it's stock market, but it's really not correlated well to it. It's correlated more to oil market, and oil and many commodities are correlated to the Bloomberg Commodity Index. They tend to move with it. Even platinum, which people used to associate with gold, is only now coming to life again. We've defined a breakout a month or two ago via momentum. But it's because the Bloomberg Commodity Index, if you look at it, after that rally that peaked weeks after the Ukraine-Russia war began, by the way. So the Russia-Ukraine war didn't drive commodities up. They'd already made their move. They doubled. The Bloomberg had gone from 70 to 140, which is still cheap. Back in 2007, it was 237. Okay, so people thought, oh, commodities are off the page. No, they're only halfway back to their old bull high. And then they drop back down to 100. But for over 2 years now, the Bloomberg's gone dead sideways. Zero decline, zero rally. It's basing. And it's trying to turn up out of here. And if you can close a month, I'll give you the number. Close a month over 106.55, I think is the number. We got up to 107 something a few days ago. Of course, that was the oil nonsense. Fortunately, got hosed down. You close a month out above there, you're going to emerge. And I bet you don't even need a headline to do it. It's just an arm wrestling. It's an asset class movement into a cheap category. It's historically very cheap. I think it's going to be a combination of both because the net technicals of the Bloomberg argue to us, one, it's massive basic. And that's one that's really going to create upset because not just because prices go back up, but because it totally upsets the political notions, about, well, now we're through with inflation. Trump's in there. We're going to drill. Nobody's going to be drilling right now. It's too uncertain. And that's not something you can push a button and it happens. It takes years. So there's a lot of false notions built into people's expectations. You don't ever buy war news. And we've tried to explain that. If you buy war news, you're going to get trapped. And sure enough, they ran oil up to 77 and then plummeted back down to 64, 65. Now, its recent low was 55, by the way, back in April. But if you start to quietly firm without any good news, just for some unknown reason, and firm back up, back over 70 in this next quarter, assume it's for real this time. And it'll also reflect what the Bloomberg is doing, which means grains, copper. Look at copper behaving quite well. So I think that will be a psychological ambush as well, indicative of money flowing out of an uncertain category, the stock market, but also psychological is a sense of, geez, if he can't cure inflation, we're helpless.